Good morning, everyone, and welcome to Beacon Pointe's Manager Insights webinar. Today's Markets and Strategy Update will feature Larry Redell of St. James Investment Company. My name is Felix Lynn, and I head up Beacon Pointe's Institutional Consulting Services Group. Today, our discussion will be a review of the current market environment and the themes and factors driving the market today and what's behind the market. As we've all seen recently, there's been a little bit greater volatility. There's been some added news regarding trade wars and things of that sort. So we thought it'd be important just to have some of our managers opine of what is truly driving the markets and how St. James is navigating these markets on behalf of their clients. Thank you for everyone's time and for joining us on this presentation. We hope you find it informative. And with that, I'll hand it over to you, Larry.
Thank you, Felix, and thank you, Beacon Pointe, for the opportunity on this webinar. I'm Larry Redell, partner here at the St. James Investment Company, and we're going to go through a few slides fairly quickly, and what we're going to cover is just a little bit about our philosophy of value investing, performance of our strategy, and then, as Felix suggested, we're going to talk a little bit about the current market and what's driving stock prices in today's environment. So, quick review, this is kind of our mission statement, and the only slide I'll really read verbatim, but we employ an absolute return mindset, even though we're long-only investors. And our emphasis is proven business models. We have what we think is a high-quality bias, and we look for these proven models and these very predictable cash flows. We look to buy them at a discount. And by doing so, we think that mitigates a lot of risk. And the last sentence, importantly, we believe entry price is a key determinant, ultimately, of return. And then the quote on the bottom from Benjamin Graham, we think there's a big difference between being a speculator and being an investor. And this is something that resonates throughout our strategy. But to us, an investor looks 5, 6, 10 years out oftentimes, and that is where we believe we find our edge. With regard to entry price being a key determinant of return, the following chart we think is really instructive. This is from Robert Shiller at Yale. And what you see are a bunch of dots, but each dot represents a year in the market, if you will. And this goes back to 1890. And what you see with the axes is the bottom axis is the prevailing PE ratio when an investor might invest in the market. And then the side axis is the subsequent 20-year annualized return. And the pattern's pretty clear. If you pay a lot for a stock, or a stock market in this case, your subsequent 20-year returns are fairly muted. But if you buy good assets cheaply, you can do very, very well over the long term. And in fact, he's done this study not only a 20-year window, but a 10-year window. And generally speaking, over the last 100 years or so, this pattern has looked exactly as you see it on the screen. So when you think about our strategy, because we are really different than maybe most managers, and we subscribe to this idea that you can mitigate a lot of risk by buying good assets cheaply and being patient, I think there's 4 kind of key differentiators to what we're doing. As I alluded to, we have an absolute return mindset, and it means we don't get hung up on what the benchmarks are doing in the short term, because we think that it can lead to a lot of mistakes, quite frankly. By thinking long term, that's where we find our edge. In the short term, you're competing with a lot of PhDs, a lot of computers. There frankly isn't a lot of competition for long-term capital because it is so tough to be patient. We run a concentrated portfolio, which means we just allocate money to about 20 of our best names. Not only does this help with returns ultimately, but we don't think risk is being more and more diversified. We think risk is controlled by knowing what you own and doing a lot of homework and really feeling good about your holdings. We do have a willingness to hold cash. And in up markets, we recognize that this can sometimes be frustrating. But as a value investor, and we're really, again, anchored to entry price, if we can't find the right entry price, and sizing the security is an important component of this, we want to sit in cash until those opportunities afford themselves. And St. James, as we're approaching a 20-year track record, this cash has been really, really important. The optionality to go in and buy assets cheaply when others are panicking has been terrific performance over the history of St. James. But in a rising market, the cash has been a drag to performance. Ultimately, we think, though, it's the right thing as stewards of our clients' capital to be very, very prudent with the way we deploy that capital and not force it just to try to keep up with the benchmark. And finally, all of our research is independent, and we think ignoring what Wall Street does has been a difference maker. St. James has never had an Enron, never had a Tyco, never had a WorldCom, never had a Valiant, and we think performance comes not only from doing your homework and allocating capital correctly, but also avoiding mistakes and not taking the big hit helps ultimately with compounding capital. So a quick just kind of overview of our process, and this is just one slide, but what you see on the slide here is Microsoft. And this is basically what we do for every company that we invest in. Notably, when we were investing in Microsoft, it was far cheaper and candidly a hated stock. But what's important is kind of the chart that you see. The top line is our estimate of fair value. And to determine fair value, we go out about 7 years of cash flow. We look for companies with predictable cash flow, and we discount those cash flows at 10%. Now, admittedly, interest rates are far lower, and many managers are using much lower discount rates. But we want to be conservative because even though we seem to forget that now that we've had a 9-year bull market, but equities are risky, and we think the right premium to attach to the risk of equities is about 10%. Importantly, that top line, though, that's where we will sell Microsoft or any company in our portfolio because that's fair value. We want to own assets below fair value, and that's the dotted line below the intrinsic value line. This is actually the tougher part of our underwriting process, because if we're considering the risk of a company and what can go wrong, that's going to determine the margin of safety we're going to demand. It means that we have to think about the business model and all the headwinds that management has to deal with. Some companies that are maybe a little bit more risky, we demand a wider margin of safety. And some companies that have more certitude of cash flows, or we don't need as big a discount. But what you see is the stock price kind of rambles in and out of those lines. When we get below a margin of safety, we add to a stock, highlighted by the green triangles. And as we approach fair value, we're trimming. Ultimately, if we've done our job well and we've got a company that has executed well, maybe the stock takes off well above fair value and we'll be totally out of the stock, as we are now Microsoft, which at 80 times earnings is too pricey for us to own. Kind of aggregating this idea to the total portfolio, this slide takes a look at the overall discount of the portfolio to our cash balance. So you see on the left axis, right now our portfolio discount to fair value is only about 10-12%. We'd like to see a greater discount to fair value. On the right axis is the cash balance, and again, that's why we have a larger cash balance this time. Looking at performance since inception of 1999, on a gross basis, we've compounded our returns above 10% annualized, the S&P at 5.5%. And we think it's notable that we actually utilize a 10% discount rate. It's our belief as a value advisor, ultimately the return that you're going to get is tied to the discount rate. So by having the discipline to discount cash flows at 10%, and those cash flows actually manifesting themselves for the companies that we own, we've enjoyed about a 10% compounded return. A dollar invested with us is now worth $5.33 versus the S&P 500, $1.79. But the way we've gone about creating this performance has not been by exceeding the market in big up markets. In fact, in big up markets, we traditionally lag and we're happy to hit singles. But what's been important is not taking the big hit and controlling risk. So what you see on page 8 is you see core equity drawdowns since inception. August 2000 to 2002, the crash of the internet bubble, the S&P was down 45%, and our strategy net was down 16. October 2007 to February 2009, the S&P 500 was down over 50%, and we were down 20. And there's some really important aspects to our ability to control losses. A, if you're down over 50%, you have to be up over 100% just to get back to even. So the core equity strategy got back to even. We made up our losses in September of 2009. The S&P 500 didn't get back to even to January of 2013. Again, if you don't interrupt the compounding process, you don't need to try to take on excessive risk when the markets are going up. You be patient for the opportunities that the market provides you. And finally, on performance, this slide highlights the kind of predictability of the strategy. This is 5 years annualized rolling of the core equity strategy versus the S&P. And you see generally core equity has averaged between 5% annualized and about 10 to 12% annualized. The S&P has been far more erratic. And in fact, there's a period from 2004 to 2012 on a rolling basis, you weren't making much money at all. But admittedly, in more recent history since 2008 and the corresponding response by central banks, we have been lagging the benchmarks. So kind of looking at what's going on in today's marketplace, there's a number of valuation metrics that are helpful. I'm just going to highlight one because we want to be concise. This is market cap to GDP, the Buffett indicator. Right now at 1.4 times, it's telling us that the market is expensive, if not more expensive, than it was at the internet bubble. Now, note, valuation indicators are great long-term predictors of performance, but in the short term, they're very poor timing tools. So we know the market's expensive, but we don't exactly know, and frankly, we've been a little surprised by that it's remained expensive for so long. But we do think there's some pretty obvious reasons for it. Looking at what's transpired over the course of the year, things have become even a little bit stranger, for lack of a better word. What you see on this chart is you see a difference between the Russell 1000 value and the Russell 1000 growth. Russell 1000 value is basically flat on the year. Growth is up 11.5%. So you've got this bifurcation going on in the market where only certain stocks are driving overall performance and value is wildly out of favor. In fact, Goldman Sachs did a study. Now, this came out a month ago, but they basically said there are only 5 stocks driving 90% of the S&P 500 performance. And in fact, they said only 10 are driving 100% of the S&P 500 performance. But the 5 stocks Goldman listed were Netflix, Amazon, Microsoft, Apple, and Facebook. Since that report came out, you can see that Netflix came down from up 120% on the year to up 76% on the year. And Facebook came down from 25% on the year, basically to flat. Stocks without earnings or stocks with extraordinarily high PEs that are more growth stories can correct fairly quickly. But the backdrop to today's market year to date is attributable to a couple of names that the market really isn't interested in what the valuation of these companies are. They just demand growth year over year over year, which is why Amazon, which is admittedly a great company, but trades at about 200 times earnings. If we kind of look at this anomaly between growth and value going back to 2009 after the bubble collapse, we see that it's been a persistent theme. Growth has doubled outperformed value since 2008, which is really kind of strange because when you elongate growth versus value since the inception of St. James, value is a quick winner. As you can see on this chart, value is up 118% with growth up 85%. And going back to 1926, Bank of America did a study. They said value outperforms growth in 3 out of 5 years. In fact, annualized, value has averaged up 17% a year, with growth only up 12% a year. So we're in a very different historical period where growth consistently outperforms value. And although at St. James we aren't tethered to any benchmark very well, given the nature of the way we manage money and our concentration with cash, etc., Obviously, our value bias is going to put us more in the value camp than buying stocks such as Facebook and Netflix. And we think the answers for what's going on are fairly obvious, and it's something we talk about a lot. But I would suggest that when we've looked back on the internet bubble or the housing crisis, what fueled those issues were fairly obvious in hindsight. But when it's going on, there seems to be justification for it. And since 2008, central bank liquidity, our central bank, the ECB, Bank of Japan, and Bank of England, has basically increased from about less than $4 trillion to $14 trillion. This liquidity, coupled with 0% interest rates, has been an enormous distortion on the markets and has perverted asset prices in a lot of ways, in a lot of different areas, including housing, we would argue. But it's perverted and caused a lot of inflation for stock prices. A lot of folks say it's good inflation, but nonetheless, it's been a perversion. Now, at St. James, we don't try to predict the future. We simply buy assets when they're cheap, and we leave others to prognosticate. But we do think it's interesting that this dynamic's starting to change. The Federal Reserve of the United States has put the Fed funds rate up to 2% from 0%. And the ECB and Bank of Japan, and who knows, Bank of China, are still in their QE situations, but they're starting to kind of taper that down. As you can see, this Credit Suisse report, they believe we're at an inflection point, and central bank balance sheets are going to start decline. And if we believe central bankers, they've told us as much. So we wonder, and albeit given the way we manage money, we hope that this is going to provide us a more normalized market that's going to reward value stock picking once again and not simply turn the reins over to the highest growth and highest momentum names in the stock market. I wanted to end with this. The idea was to be short and concise, but these are just a couple of the things that we're seeing in the marketplace. As Felix and his team at Beacon Pointe knows, if there's any follow-up questions or we'd like to look at it further, we certainly make ourselves available here at St. James. And for those of you that are trusting your capital with us, can't thank you enough for the partnership.
Great. Thank you again, Larry, for your thoughts on the market and the update on your strategy. This was very helpful for us in helping understand what's driving the markets today and going back a few years, as well as how you at St. James are positioning the portfolio and how you think the portfolio will perform relative to the risk and the opportunities in the market. So thank you again. Thank you to all of our clients listening in. We appreciate your time and relationship. Please do not hesitate to call your consultant if you have any questions on the markets or if you'd like to dive into St. James' investment strategy further in detail. In addition to reaching out to the consultant, you can always send questions to bpawebinar@beaconpointe.com. And we look forward to having you attend our next Manager Insights webinar. Thanks very much. Have a great day. Take care.